Every morning in a crowded market, Rohan boils water, crushes ginger, and arranges his cups. This small business is the engine of the Indian economy. Rohan has 24 hours in a day and a finite amount of cash in his pocket. Because he cannot buy every ingredient in the market or serve every customer in the city, he has to make difficult choices. Economics is the study of how people manage these limited or scarce resources. To stand here pouring tea, Rohan sacrificed a steady salary at a corporate IT job. In economics, we call this an opportunity cost. The true cost of any decision is the value of the next best alternative you gave up to make it. When it is time to buy supplies, Rohan doesn't try to trade the wooden chairs from his stall in exchange for milk. That kind of barter is inefficient. Instead, he uses money, a standardized tool that everyone in the market agrees has a specific value. Because resources are scarce and every choice requires a sacrifice, Rohan assigns a numerical price to his time and his product. That basic, everyday calculation forms the bedrock of all economic activity. Rohan buys his milk from a local dairy farmer instead of raising a cow himself. By focusing on his strengths while the farmer focuses on his own, both men work efficiently. We call this specialization. Watch how buyers react. At 20 rupees, 100 people buy chai. Raising the price to 100 drops volume. This is the law of demand. Now consider supply. Frost destroys tea leaves, increasing ingredient costs. The supply drops, forcing a higher price to break even. In 1776, the philosopher Adam Smith described this interaction as the invisible hand. The dairy farmer and Rohan both act in their own self-interest to make a profit, seeking their own gain rather than the benefit of society. Yet through that pursuit of profit, society gets fed. A free market doesn't need a government official to calculate the city's milk needs each morning. The mutual desires of buyers and sellers naturally coordinate the distribution of goods. Let's expand the scale. Rohan's stall is successful, and he wants to open a second location across the city. To do this, he needs 2 lakh rupees, far more cash than he has in his register. So he goes to a bank for a loan. This flowchart shows how banks handle our cash. When a citizen deposits their savings, the bank doesn't just lock it in a vault. By law, they keep a small fraction in reserve and lend the rest to businesses like Rohan's. Rohan uses that loan to buy a new cart, and the cart builder deposits that money into his own account. The bank then lends a fraction of that new deposit to someone else. This cycle causes the total amount of money in the local economy to grow far beyond the initial cash deposit. This lending process fuels growth, but it has a limit. If banks lend out too much money, buyers suddenly have an abundance of cash. If they all try to buy a limited supply of tea leaves at once, sellers will raise their prices. We call this inflation. The opposite is deflation. If bank credit dries up, people stop spending. To attract the few buyers left, sellers must crash their prices, which can cause businesses to collapse and the economy to stall. While credit creation helps Rohan build a business, an unregulated money supply will eventually destroy the purchasing power of the average citizen. It begins to take more and more rupees to buy the exact same cup of tea. To prevent the currency from losing its value, a central authority steps in. In India, this is the Reserve Bank of India, or RBI. They are responsible for controlling the national money supply. Their main tool is the repo rate. Think of this as the baseline cost of money. It is the interest rate the RBI charges commercial banks when those banks need to borrow cash. When inflation gets too high, the RBI raises the repo rate. The commercial banks pass that higher cost down to regular customers. Suddenly, Rohan sees that his expansion loan is too expensive, so he pauses his plans. Across the country, spending slows and inflation cools down. The central bank acts like a master thermostat for the country. By constantly adjusting interest rates, they keep the financial machine running at a steady pace, preventing it from overheating or freezing up. If we zoom all the way out from Rohan's local market, we can look at the output of the entire country. To understand if a nation of over 1 billion people is healthy, economists measure gross domestic product. This diagram shows the scale of that measurement. GDP is the total monetary value of every final good and service produced within India's borders in a single year. It is the combined output of every farm, factory, and tea stall in the nation. An economy relies on physical goods, but it also depends on the skills and health of the people behind them, a concept called human capital. When Rohan's workers are well trained, they produce more tea per hour, increasing the country's productivity. To truly understand health, we must recognize the difference between income and wealth. Income is the cash Rohan earns at the end of the month. Wealth is the long-term value of his equipment, his savings, and the reputation his brand has built over the years. A high GDP and steady income indicate that the economic engine is running today, but true national prosperity requires the sustained, multi-generational accumulation of wealth. India operates as a mixed economy. It relies on the free market invisible hand of entrepreneurs, but balances that with the infrastructure and stability provided by the government. The state builds the roads, and the RBI maintains the currency. They provide the secure foundation that allows millions of people like Rohan to safely take a risk, open a business, and trade with their neighbors. So the next time you stop at a local stall to buy a simple cup of tea, you aren't just a customer. You are a direct participant in a $3 trillion network where millions of individual choices keep the entire nation moving.